Hello and welcome to the Help My Wealth podcast, Money Rules or Money Rules. Here at Help My Wealth, we are all about empowering financial success in our community of listeners. We hope you find today's topic both informative and helpful. Welcome back to the Help My Wealth podcast. I'm your host, Stephen Logan, and today I have with me Hamish Ferguson and David Lennox. Thank you for coming.
Thanks very much, Steve.
You're welcome.
Hamish has been a mortgage broker and a financial planner for 25 years now?
No, 21 years.
21 years, right? And David, you're a chartered accountant for 30 years and a mortgage broker for 23 years, is that correct?
That's right. You're making us sound old, Steve.
I know, it does. Sorry. Hamish has been a mortgage broker for 1 year and David...
Yeah, that's better. Well, I remember when we started, I looked at people that were brokers that were my age and was critical and thought that they were over the hill, and it doesn't take long to actually be that person on the other side of the hill.
But look, you come to us with a wealth of knowledge and wisdom, so, you know.
Yeah, well, thank you for having us, and I'm looking forward to it.
Yeah. Look, on that subject, I mean, please tell us a little bit about yourself and about Vision and Vision Aggregate and what you do.
Used to be an accountant, and me and my business partner, which isn't Hamish, formulated the business idea in a car coming back from Mudgee Sevens rugby tournament. That was sort of mid to late 1999, and by early 2000 we were in business, and that was the early years of mortgage broking, and we came from very different backgrounds. I was an accountant, more sort of credit and operations and that sort of thing, and he was the hardcore sort of no fear selling, but had a very good financial brain. Matt Ivers, who's my business partner, and then within 12 months, Hamish, who had already had the challenge of a growing family, which I didn't have at that time, was looking for a new challenge. He'd done his back after years of retail and had a young family, and he was looking for a change. And I think that combination of the hunger we had and the challenges we needed was the perfect storm. So we really, all three of us, the Vision Sydney and the Vision Newcastle, really hit the ground running in those years, sort of 2000, 2001 through to 2006. I think both businesses sort of doubled every 6 months for about 3 or 4 years. And since then, the two of us have branched out into different areas, myself into aggregation and property, and Hamish, he can explain. But we're very much joined at the hip in terms of the branding of Vision. And with Help My Wealth, we sort of have a yin and yang. We're old schoolmates and pretty much can finish each other's sentences these days, and I feel very privileged and honoured is not the right word, but fortunate that we can sort of still have this sort of lasting friendship
after 20 years.
Yes, we like any relationship, whether it's with a great mate or a partner or a wife, it's not without its challenges, but we get through it, and it's still very enjoyable, and I look forward to it continuing.
So I'm going to throw a bit of a curveball here, Dave, a little bit. And I know it's prior to this part of the story, but share a little bit about, being in Russia or the USSR, earlier on in your life. I believe you abandoned my wedding to work in Russia around the collapse of the USSR. Was that about right? Or?
Yeah, it was just outside that time frame. So I do have Russian heritage. My grandmother was born in Russia. The opportunity at KPMG came up at the Moscow office in 1994, 95. So myself and my girlfriend at that time, we took that opportunity. It was one of the only offices in the world where we could go together at the same time. And yeah, it was just outside that period when it's probably a dirty word talking about Russia now, but it was a time when it was extremely exciting. They were just exploring the opportunity post Iron Curtain, and
almost the rebuilding stage. Would you? Yeah.
Totally. There was so much optimism, and the Russian people that
so
I was.
Gorbachev still?
Yep.
Yeah.
Gorbachev into Yeltsin. Well, mainly Yeltsin when I was there, and I'll never forget the day when I spoke to Hamish on his wedding day. I think I forget where exactly was it.
I was in Nelson Bay. Yeah.
Nelson Bay. I was in Siberia, and I think the temperature of his wedding day was something like 36, and I was pretty much minus 36. So there was a 70-odd point difference in the days. Anyway.
Yeah. So listen, look, on that, what was your take-home message, to watch a community go from being, quite heavily watched, quite restricted. All of a sudden, they've got this hope for the future. They're not sure what's going to happen, but they believe it's better. I mean, it must have been an exciting time to be a part of.
It was such an exciting time to be there because and dealing with the accountants in the Russian office was just outstanding. They were brilliant people. If I was to reflect one thing that they probably did, it's a very easy in hindsight, but they probably just tried too quickly. The rush with which everything happened, the privatising of all the major assets and the forming of the oligarchs and how much wealth went into small hands and that's probably how they'll reflect that things just happened so fast. But working with the Russian accountants and over in possibly Eastern Europe, but definitely Russia, accounting was a very female-dominated profession. And the males in the family were doctors and university lecturers and those sorts of things. Accounting and bookkeeping was seen as a very menial and female-orientated task. So most of the people in the office were young Russian university graduates and with a lot of hope. But what the dynamic was, and I say this to people, is they were suddenly receiving Western wages, working in US dollars. For a company like KPMG, they might have been on 40 or 50,000 US dollars a year, which if you added up their husband, their mother and their father and combined those three salaries and tripled them or times them by 5, the young 23-year-old girl was earning more than that. So that was a very unusual dynamic for Russia to be dealing with, that suddenly you had these 25-year-olds earning more than their university doctor, professor, father. So that would have been a challenging thing too.
And look, you touched on it a little bit before, and I think for a lot of our listeners, especially those that are younger, wouldn't remember or even understand. But when you started Vision with Matt and then later with Hamish, that was during the time where the industry was being deregulated, the government was changing from big four banks to allowing other things to open up. Can you just explain what that was like at that time and why you sort of saw that as an industry that was worth getting involved in? Because I think people these days, we've got so many mortgage brokers and so many options. I don't think people realise what it was like prior to that in the 90s.
Great question, Steve. So I think we've just ticked over the 70% of loans being written by mortgage brokers. And
that's correct.
And I think back when we're talking the early year 2000, we were in that 10% category.
Yes.
And already the dynamic in the US and the UK, they were at the 40% mark already. So it was always, and because it's a pro-choice, consumer-orientated industry, it was always going to follow that path in the Australian economic environment, because we're a very egalitarian, pro-choice type society, that we're always going to head down that path. So being involved from that 10% through to 20, 30, 40%. Once we hit that 40, 50% mark, which might have been, about 10 years ago, it became more sort of broker-to-broker competition. In the early 2000s, it felt like a no competition market. There weren't many brokers around. There was so much business. Getting people to move from direct lending relationships into third-party or into using a broker was really a no-brainer. People became time poor. There was more choice out there. I always use the analogy that if you go and talk to CBA, they'll talk about yellow paint. If you go and talk to ANZ, they'll talk about blue paint. If you go and talk to NAB, they'll talk about red paint. I don't know if I've mixed those up. But anyway, if you come to a mortgage broker, we've got all the different colour paints.
Yes.
We can talk about all of it, and we can talk about other things as well, not just paint. So
we were the rainbow, were we?
We were the original rainbow.
The original rainbow. And I think that's important to note, because for a lot of people, they don't realise that, back before that, there wasn't a lot of choice. You had the big four banks or a few others, and whatever they were offering, that was it. So competition was quite small, wasn't it?
That's right. And look, when we go back to the times when our parents got mortgages and our grandparents got mortgages, if they were lucky, they would turn up and talk to the bank manager, and it would be a student and headmaster style relationship, right? They would go and talk for an hour or two, and they might get a call 2 weeks later with some sort of broad offer. So it was a very, very nerve-wracking experience. Now, fast forward 20, 30 years to the current environment, it's like the shoe is on the other foot. It is consumer-driven, and it is who is lucky enough to get my business.
Yes.
So it hasn't taken that long for that dynamic to change, really.
Yes.
But it's become a very consumer, and whether or not that's gone too far one way, who knows? And maybe we're seeing a slight rebalancing of that with the slightly more difficult environment to get credit, that people can't just turn up anywhere and get what they want. It's a little bit harder, and that's when we come back into play a little bit more.
Yes. Yes, and actually be able to answer. I mean, look, recently I had a friend of mine come and see Hamish. Actually, they had been talking. They've got a build coming up, and they'd been talking to another provider prior to that, and they were just sort of explaining that they didn't understand why use a mortgage broker. Do you know what I mean? And my comment in the end was, look, it's not my area, but I really suggest you have a talk. Just it's free. Have a chat, have a talk, and go from there. And it was fascinating him coming back going, I wish I'd done this years ago. I didn't know the questions I had to ask, let alone what the answers were. Do you know what I mean?
Yeah.
So by the time he finished talking to Hamish and talking to Liam and having that roundtable discussion, he felt more empowered. Now whether he ends up going with Hamish and Liam, whether he goes in with another provider, it doesn't matter. The fact that he actually had that discussion, he left that situation going, I feel better about where I'm at and what I understand. And I think that's the power of mortgage brokers and of the ability that you guys have, like you said, not having to go to a blue or a red or a yellow paint to be able to choose, hang on, this is the client, what's the best product for them? Have you thought about these other questions? Have you even, thought about the questions, let alone the answers to these, and then bring that together to say, I think this product will actually suit what you're wanting to do really well.
Yeah. Good point.
Yeah. Well, look, today we want to have this our topical conversation. This is our podcast that we look at a certain topic. Hamish, what have you brought to us to the table today?
Yeah, well, I'd really like to talk about just, I guess, that journey of what it means to, invest over the next couple of years, given all of the uncertainty we've had. We've just talked a little bit about, Russia and yes. what it was like 30 years ago. And, of course, that's gone full circle now in terms of that being very topical, inflation, interest rates, things like that. And what do you do with all of that? So that's probably the thing I'd like to just discuss a little bit further.
Okay, fantastic. And David, what would you like to discuss today?
Oh, look. We're doing this in late December and people are sort of in the middle of their holiday period and they've had a fair bit of stress over the last 6 months in terms of 6-7 straight interest rate rises coming out of the holiday season, and how to sort of deal with the challenges ahead, whether rates go up or down. What do people do? I mean, everybody's paying a lot more than they were 12 months ago in terms of everything, their repayments, fuel, power.
Yeah, totally.
So
building costs,
how they cope with that, get on with their lives and try and build mechanisms to cope with that.
Yeah. Well, look, Hamish, I'd like to start with your question and in regards to interest rates. I thought it would be interesting. I had someone talk to me recently about, in the media they hear everything about this, RBA, they're setting interest rates or prices. Now, they didn't really comprehend how that affects them personally in regards to their actual interest rates. Do you want to just explain to our listeners, in point form a little bit about what that means to somebody?
Yeah, well, look, interest rates actually affect us quite a bit in a lot of different areas. So it's not just, the home loan rate that we pay that it impacts us on. So, for example, one of the things that all insurers have to do in Australia is when they collect your premiums, so whether it's car insurance or home insurance or whatever it happens to be, is they have to put some of that money away, right? And they have to put it into fairly conservative investments.
Yes.
So that it just means that if there's a mass claim on something, that they've got that money up their sleeve. So the interest rates in society actually affect what our premiums are. So the higher interest rates are, generally the more competitive the premium market is, because they're making more money on those premiums or those funds that they've put aside. In a low interest rate environment, our premiums tend to go up a little bit quicker because of that reverse effect. So that's one that a lot of people might not actually quite understand is how interest rates. So it's quite often talked about in the marketplace that interest rates only affect homeowners.
Yes,
but it's not. I mean,
no.
Anybody that has any type of insurance product is affected in some way by insurances.
And so when, the Reserve Bank of Australia, the RBA, go and set a new interest rate, how does that flow on to all of us?
Yeah, I guess,
Because that's what the media report, don't they? I mean, because that's the easy one. That's the standard. They report that and then it's left to us to assume what that means to us.
Yeah, absolutely. All right. So look, the Reserve Bank, when they talk about interest rates, they're typically almost talking about the wholesale rate, the rate that is delivered in some way to everyone else.
Yes.
All right. So, and then every lender or every bank then puts their margin on top of what that wholesale rate is.
Yes.
And I'm trying to explain that in probably a way that everyone will understand. It's probably a little bit different to that in terms of, but generally, if you call it a wholesale rate, then your understanding of what the Reserve Bank's talking about is typically right.
That's a good way to put it for a concept, that's for sure. Yeah.
So, and then typically when the Reserve Bank comes out and changes the rates, what they're trying to do is, in Australia especially, and probably I don't know, Dave, if you would agree with this, but most Western democracies, the Reserve Bank or the central bank of that country, it's typically been the only way that that the government's had to be able to quickly or reasonably quickly change how the economy operates and whether they use it as a mechanism to speed things up or slow things down.
Yeah, well, it is one of their main levers to do that, isn't it, in the economy? So,
Yeah, absolutely. So that's what the Reserve Bank's doing. But, everything gets impacted apart from that. So if you've got a credit card, your interest rate's impacted by that.
Yes.
Any business that borrows money to grow or to maintain things,
yes,
they're all impacted by interest rates going up. So you might look at it and go, well, wait a second, if I'm buying a car and I'm paying cash for it, surely interest rates don't impact me on that. But the dealer, right, would be paying leasing costs on the vehicles that they're actually bringing in, all right?
Yes.
So the more cars that dealer holds, the higher their costs are that they would be having to pay to actually keep those cars on the dealership. So, even for that 18-year-old that doesn't have any debt or anything like that, the impact of a car can be changed with interest rates.
It was brought up to me recently. I didn't even think of this as a concept, but quite a lot of large companies actually use a loaning situation just to pay their wages. So they'll actually do their pay runs via almost like a loan that's an agreed upon with the bank. So they pay their wages with the loan and then they, will pay that back. And that way then the money's just always there. They're not worrying about cash flow moving forward. But I mean, you think that across Australia, across some of the large employers, even that alone is affected by interest rates too.
Well, any temp company that hires out workers to, whether it's the big manufacturing companies or,
yes,
or mining companies, generally they've got to pay their workforce, either weekly or fortnightly. And a lot of these mining companies might have 60 or 90-day terms.
Yes.
All right. So those recruitment companies all have to fund those wages, usually through some sort of borrowing mechanism.
Yeah.
I don't know, Dave, are there any other examples where interest rates can impact that you can think of? Or?
Well, I think the main thing that they're trying to impact is the cost of the house over the short, medium term. I mean, that's the thing that's one of the things that's really been, Australia has this amazing propensity to enjoy buying property, whether it's a home to live in or to upgrade or to rebuild, but accumulating investment property, that's been a massive sort of shift over the last 30 years is people's propensity to build a property portfolio to protect themselves in their retirement, not wanting to rely on a government pension or their superannuation, which we've seen can crash 12, 18 months out from retirement. So people are trying to build all sorts of mechanisms to protect themselves in retirement. And we're not just talking about the wealthy class. I mean, 50, 60, 70 years ago, the only people that owned a property or multiple properties were the sort of the wealthier class, whereas now we are talking, Hamish, if you think about your own business and my business, we've got school teachers, nurses, all sorts of blue-collar, professional class workers that have used the equity in their first home to accumulate 1, 2, 3 or 4 properties, right? It's become a real shift in the Australian landscape is for the let's call it the ordinary Australian to build wealth through property.
Absolutely.
And that is a misconstrued thing that the media quite often brings out as well. Is that if you change the regime around property, that you're affecting the wealthy, but you're actually not. You're actually affecting the middle class more often than not, or the average mum and dad. So
Yeah.
And look, and so interest rates obviously make it harder for people to buy that property or to grow that portfolio, but it also, the people that own the property, they're more inclined to want to increase their rents, which is another topical thing for the moment because of how many parts of the country over the last year or two there's been this significant low vacancy regime or time where it's just so hard to get a rental at an affordable price. But it's not really the property owner's fault because all they're doing is trying to, balance the books, to an extent.
Well, my concept always been when I talk to a lot of my investors themselves, especially people who are fearful about increasing their rent, because I actually find most landlords I talk to don't like increasing rent. Do you know what I mean? They're not there to keep on just piling on top. And I find the average person, I'm saying to them, to start off with, you've got to look at what your costs are this year compared to next year. Do you know what I mean? If you could buy, 2 McDonald's hamburgers with $10 in 2022, can you buy 2 McDonald's hamburgers in 2023 with $10? If you can't, then you need to ensure that your rent has increased by that amount of money. So if your rent is $300 one year, is $300 next year going to buy you the same amount of McDonald's hamburgers or not? If it's not, then you need to increase it by that CPI, by that inflation, just to be able to keep it at the same level, and then go from there.
Just a quick check, Steve. You're not being sponsored, are you?
No, not by McDonald's. I could have used milk too, or bread.
People could get mistaken that we were sponsored. Just been a good Christmas. Yeah.
So, coming out of this Christmas time, Dave, that you were sort of talking about, what are, I'm just trying to kick off this part of the conversation, but, what are the thoughts or themes that come to mind for you that you think, again, those average Australians are going through at the moment or thinking about?
Yeah. Well, I try and settle people down by explaining that it's not an unusual environment, and that they're one of many, right? So, for a lot of people, I think of people that would have been first home buyers that we would have done transactions for back in, let's say, 2010, 2011, right? So those people might have been 30, 35, nearly turning 50, and this is their first ever rate rises, right? So, and it's just not one or two, it's 6 or 7, whatever the number is. So it's like they haven't had time to adjust. But even the rates now, and we don't like to talk about prior generations, but they're still reasonably low by historical standards. And we've got our parents and even people younger than our parents that can remember when the rates were in their teens. So the analogy I use is that, let's say the average price of a bottle of milk has traditionally been around $5 or $5.50 or whatever. We've been lucky in our society to have that bottle of milk at sort of $1.50 for 8 years, and that cost of the bottle of milk going down and down and just sitting at $1 for 2 or 3 or 4 years. Well, now that bottle of milk might only be $4. It's still 3 or 4 times what you were paying, but it's still, in historical standards, still a reasonably priced bottle of milk. Now, in terms of how do people cope with that, and I think most of our clients are reasonable people. They know they don't go into home ownership and mortgages with their eyes closed. They know that things like this might happen, and none of us really know what's going to happen to interest rates. But what we do know is that they might go up, and that we should be preparing ourselves for higher costs. And how do we do that, right? How do we prepare ourselves, for that higher cost environment,
And it's interesting you bring that up in terms of what we should be expecting. And of course, we've had, Governor Lowe recently cop a lot of heat for, his comments only 2 years ago about interest rates in 2024, that we shouldn't we shouldn't see any rate rises. My words, not his, but obviously he's copped a lot of heat for that, and so, and it's interesting in the sense that we all know rates can go up, but it's processing the likelihood of these events happening and when, and how do we prepare for them. So, so I do think that a lot of people have sort of gone, wow, bang, bang, bang. These rate rises have just kept coming, and we don't even know if it's technically finished yet. All right, so it must be for a lot of people, especially if they've bought in the last couple of years, quite a stressful thing, especially when you've got your parents in your ear sort of going, well, I remember when interest rates were 16, 17%. And they just know that they can't cope with that sort of increase. So there must be, I shouldn't say must be, there is a level of stress out there around how people, are coping with these changes as they unfold.
I think it's also important, though, to note that, we went through this period of COVID where the government used that lever to try and, help the economy to stay afloat. And they really reduced interest rates down to, an all-time historical low. Yeah. And we've gone, like you said, bang, bang, bang. And the media's love to advertise just every time there's a rate rise and it's the end of the world type thing. Mm-hmm. But I mean, we've also got to remember it came down, like it really came down quite low. And sure, it's gone past where it was at. But if we take out that, odd couple of years where the government was doing everything it could to encourage an economy that was, in a world pandemic, the difference is it's not as significant. Do you know? I mean, what were the interest rates prior to COVID?
As Dave said, it hasn't gone up, right, for 10 or 11 years prior to now. I don't know exactly what the rates might have been at any one point in time, maybe mid threes, high threes. It's.
Well, I would say it was sort of around that. I guess that's what I'm saying is that we've gone from that sort of, just high ones, low 2%, and now we're up to where we sort of sitting at around about now in average.
Probably high fours to early fives.
So it feels like when you've gone from 2 to 5, do you know what I mean? That's a big. But if we take that COVID period out and we're going from mid threes to fives, there's a difference there. People don't like to, or the media doesn't like to actually show that. Yep, there has been a rise, but they like to show it going from 1% to 5%. Do you know what I mean? Not going, hey guys, let's take out this area where the government had to do something really important to make sure our economy stayed stable during a pandemic. Let's look at it from where it was prior to that to where it is now. Do you know? And if we actually even everything out, it's not this doom gloom situation that we're so worried about.
No, doom and gloom, boom and bust is what sells. It's clickbait. It's what sells papers.
That's right.
So people do need to be very cautious about making decisions based on reading that stuff.
Yeah.
Right. There's far more reasons to be calm and to plan how you're going to cope through these things rather than reacting. And the most aggressive form of reaction for us, or given that we're in this industry, is to sell something when they may not need to.
Yes.
Right?
Yes.
And I think, it is important to know that this isn't the only time the Reserve Bank had come out and alluded to the direction that they thought things were going to go. And it has become a more common strategy for the Reserve Bank to almost say, well, I don't really want to put rates out there up, so I'll scare everyone by saying rates might go up, or and obviously this is the reverse of that. So, I mean, in hindsight, if we go back to, early 2020, the world was a mess, they had to try and instill confidence in us being able to make everyday decisions. I mean, little things, going back and talking about, the savings level through 2020 was the highest it's been since the 70s. So people weren't wanting to spend money, all right? So because of this fear that, well, wait a second, we're all locked in our houses and we're all, we're experiencing something we've never experienced before. So, you can understand, them trying to come out and make comments that might give us a bit of confidence that we can sort of get on with life and do things and borrow money, which is, typically what sort of happened. So yeah, but it's still a reminder that a lot of our clients and a lot of the people that we're talking to, have gone from that 2 to 5 means that their repayments may have doubled.
Yeah.
All right.
Yeah.
And that might still be flowing through as repayments sort of change. So,
and regardless of the reason, that hurts.
It does.
Yeah. So I guess my comment to both of you is, what are you saying to your clients at the moment in regards to these interest rate rises? What are there ways that people can actually feel more in control of what the products they have in regards to actually paying for those if they feel that they aren't able to make the repayments? What are you sort of saying to people that are coming to you in that sort of feared state?
You want to start off with that, Dave?
Well, we stress test our clients in terms of where rates might head, and we do a budget and prepare them for rate rises and look at what happens to their budget. It's very simple. We have a very simple way of doing that so people can understand it. And there's all sorts of things they can do to help that situation. I mean, the ugly or the most of the public don't really like being directed as to what to do, but certainly being careful with spending, there's no hiding from that. That is a mechanism which will take people through their life, right? Being cautious about spending. So that's one area we talk about in terms of, okay, if things do go up, what can shift?
And that's just a bit confusing because, of course, the problem we had 2 years ago was that everyone was basically going, no, spend. And now we're saying, no, pull back.
Well, people have a right to be very confused, especially with this inflation cycle, because on one hand they're being said, well, this is sort of overseas factors and all these global things, and then they're being told to tighten their belts, and people don't like being told to change, including me. So people are very confused as to what's creating this massive thing. Is it overseas? Is it here? Is it themselves? So people have a right to be confused. But the things we're talking about in terms of just generally responsible spending, that relates to any cycle, right? It's not a rate rise cycle. It's any cycle. It's it's just part of building wealth, really.
I think it's important to actually, think of that as a cycle as well, and to recognise that however long this situation is going to go on for, there is going to come a time where interest rates will most likely come down again. No one has a crystal ball. No one can say when that's going to be or what's going to happen, but it's for a period of time. We're not saying for the rest of your life you're going to be paying, this level of mortgage repayments. It's about going during this period of time. You need to pull yourself in, make sure your spending habits are being controlled, so that you can, like you said, pay for the things that are important and not have to sell an asset that in 5 years' time or 10 years' time is going to be worth a lot more than if you had just sold it now. So, you can get rid of short-term pain.
Yeah, and just, you're right. Nobody likes to be told, all right? So, but I think for ourselves, we have to learn to say no to things.
Yeah.
I heard an example yesterday where in the Philippines, they went through a season where onions were as expensive as steak.
Yeah.
All right. So, okay. Well, yeah, I guess the lesson in that is we just don't buy onions at the moment, I think watermelon recently was, it might have been over $10 a kilo, which means you're paying $30 or $40 for a watermelon. Well, again, we're so used to watermelon, being under $2 a kilo type thing. You just don't buy watermelon at that point in time.
Yes.
But of course, it's summer. We want those summer fruits. We want to enjoy those things. And so it's tricky because, and I think as a society, saying no just isn't popular. It's we want to be told yes all the time. So it's a new thing for a lot of us to really have to get used to be saying, well, no, not now. We just can't do that at the moment. And that's just going to be different for each individual person. Well,
look, thank you guys for your time today. Really appreciated talking to you both. Before we go, is there any take-home message you want to pass on to the community of listeners?
Look, I think it's just I think 2023 is going to be a good year. You know, like I think that that's a pretty bold statement, and of course there's a lot of uncertainty out there. But I do think that, you know, for me, it's about saying, look, you know, the glass is half full. There's plenty of things that we can be doing, all right, to actually to work on our lives, improve things, and it's just a matter of finding those opportunities. So, yeah, to the listeners, my recommendation is get out there and find those things that you can do.
My message would be to be calm, not to react too quickly. You might be feeling under pressure, but don't panic. Talk to us. And quite often the process of just talking about it, analysing a few key figures, 24 hours later you'll feel better.
Yeah,
that's good.
Yeah, I think they're great take-home messages, and I think that's very true. Too often we let media, social media, the normal media, you know, take our emotions and flow with it, you know, and it feels... Let's face it, they go from one fear to the next. If it's not the war in, you know, Ukraine, it's the interest rate rise. If it's not that, it's, you know, a Jetstar jet that had to turn around 4 hours, you know, into the thing. They've got to find something, you know, to be able to talk about. So I think you're right. Stopping, talking to a professional, actually going, this is my problem. How, you know, can we together come up with a solution is a good way of going. Because I actually agree with you, Hamish. I think 2023 is going to be a good year. I think we've come out of quite a lot of hard times over the last few years with COVID, and then, you know, even sort of post-COVID, that whole just getting into stability. I really see that, you know, when I read a lot of things happening in different industries, it is going to be quite a buoyant year. So maybe we'll revisit this clip in 12 months' time and see if any of us are correct.
See if watermelons come down.
See if watermelons come down. That's right.
That's a big one.
And Big Macs.
And Big Macs, which we are not at all advertising that company.
No.
Or milk companies. Either.
No.
Yeah.
All right.
Well, look, thank you guys. I appreciate your time. Thank you to all the listeners. And as always, Help My Wealth is about empowering your financial journey. I hope that we've been able to do that today by talking to David and Hamish, and we'll talk to you again. As always, please like and follow us, and we'll see you next time. Thank you.
Thank you.
The information discussed by the Help My Wealth and the Money Rules podcast is for education and entertainment purposes only and is general in nature, and it is not advice. It is not intended as a substitute for professional finance, legal or tax advice. It is aimed to provide a general understanding of each topic and should not be relied upon to make an investment or financial decision. It is strongly suggested that you seek professional advice regarding your own individual circumstances before making a financial decision. Help My Wealth and the hosts of the Money Rules and Money Rules podcast are not aware of your personal financial circumstances. Before making any financial decisions, you should read the product disclosure statement and, if necessary, consult a licensed financial professional. Do not take financial advice from a podcast. In the spirit of reconciliation, Help My Wealth and the Money Rules or Money Rules podcasts acknowledge the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to past, present and emerging elders. We extend that respect to all Aboriginal and Torres Strait Islander people today.